Hi. Hey, everyone. So hi, and thank you for joining me. Today is April 9th, 2020, and this is an update on everything. There's been a lot going on, and it's really difficult for you guys to probably keep up with it all. I know for me, and this is what I do, it's hard to keep up with it all. Things change very rapidly, but the general themes are still the same. The feds released their minutes from their meetings, their two emergency meetings yesterday. And a lot of what they said was something that they had already said in their press conference. So it wasn't really news. It was information that we really have already reported on for you. As you well know, I started reporting that COVID was going to be a very big deal on Valentine's Day. The markets went ahead and went on up to an all-time high by February 19th, but since then they've really dropped. So the lowest that they've dropped is minus 35%, and currently they're minus 20%. So this is really important because what I'm seeing a lot of are a lot of money myths, money pits, scams, all that sort of thing. And these are preying upon your lack of information. There's too much information and most of it is noise. So I do want to remind you that the first thing you want to do before you listen to any bit of information from anybody is to, first of all, grade your guru. And then secondly, understand what, what their motive is. So for instance, politicians, as you've seen, have been saying everything's okay, and then they've been selling and getting into trouble for it. So what is their motive? Behind their motive is actually something that's important, and that is to keep us optimistic and to keep us pushing and doing the right things so that we get on the other side of this crisis and we infuse the economy back with our employment and our spending powers, and we save the businesses we can save, and we restructure the businesses that need to be restructured, and we let go of the businesses that maybe shouldn't have been in business in the first place. So their job is to keep us optimistic and to assure us that they're solving the problems. But if you are able to watch their actions, which usually you're not, but we have seen a few reports now that you now know there's been a lot of people selling on the insider side. If you were able to watch their actions, that would be more revealing than what they were saying. So I would not necessarily rely upon politicians for my economic information. And there's another reason for that. In the Great Recession, we had a series of unfortunate events that actually started in early 2007. And the market high was October of 2007. And then, each one of these events would unfold that showed us, oh my God, this is much more severe than we originally thought. And by the time that the market hit its low, that was March 9th of 2009. So the high was October 2007. Now, the politicians didn't admit that we really were in trouble until they asked for the TARP bailout money. That was October of 2008. And the markets had already lost about 48% by then. And for those of you that are hearing that myth, if you're selling now, you're selling low because stocks are at an all-time low, or why you should be buying now because stocks are at an all-time low. That's a myth. The Dow dropped to 6,547 on March 9th, 2009. That's not ancient history. That's 11 years ago. And that was in the last recession. And remember that the dot-com recession before that, the NASDAQ lost 78% of its value. There are some of us that remember that time. If you're a millennial, you were probably born, after that time, so you don't remember it. But it's really important to have facts. And there are a lot of people that are giving you facts that are not necessarily telling the full story. So grade your guru and understand what they can and cannot say. As another example, a few days ago, Jamie Dimon, who's the chairman of and CEO of JP Morgan, he just had emergency heart surgery right after the COVID crisis. He's now back at work. I don't know if it's full-time or not, but he did write the letter to the shareholders. It was released a few days ago. It's linked to in my new blog, the one that I'm linking to in the chat. So you can link to both if you're interested in the online retreat, or if you're interested in accessing that blog, it should be in your chat box, and you should be able to easily click on both now so that you have those pages open. So what Jamie Dimon had said, he said a lot of things, and he said them frankly and clearly. Now, why in the world would he do that? Well, because he has to. Now, that's again the thing. What is the intention here? The annual shareholder letter is a legally binding document. And if he doesn't tell the truth there, then all of his shareholders can sue him. So he has to tell the truth there. What did he say? According to his very experienced perspective, we are headed for a pretty bad recession. He thinks that it may be as severe or more than the Great Recession. He said that, and this is another thing about the dividends, which we're going to talk about and are definitely included in that blog that I linked to. He said that right now they have suspended buybacks, so the bank is no longer repurchasing shares. That's a big deal because this whole bull market has been built on corporations borrowing money very cheaply, buying back their own stock, and pushing up the share price. Also, by the way, that even though the share price is getting pushed up, the price to earnings ratio is actually going down. That's financial engineering. I don't want to explain all of that to you, but it's important to know that so that people think it's getting cheaper. It's financial engineering. But the bottom line is they are no longer doing that, and a lot of corporations have had to suspend their share repurchases. In fact, a lot of corporations have also suspended their dividends. Now, Jamie Dimon said, there's only the worst case scenario, it may be that they'll have to suspend their dividends. And in the tea leaves of the rest of the letter, he kind of said, it looks like we're headed for the worst case scenario. So what I saw this morning in a report from the S&P Dow Jones indices, and they are great about getting outstanding data. 13 S&P 500 companies have already cut or suspended their dividends. 10 of the 13 were suspensions. He said there are 40 suspensions in 6 days, just this week, from non-S&P 500 companies. But the upcoming earnings season is when we're going to see more of this. This is really going to be where the proof is in the pudding, because usually the companies will have to, this comes from the board, and the board is going to be meeting during earnings season. So we will very likely see a lot more dividend cuts. So if you are reading anything, and some people have been sending me in questions or on their private coaching asking me questions about dividends, because there is an active campaign out there to get you to buy into dividends, with even options traders are giving you fancy ways that you can buy into dividends. Well, hey, if all the companies are either suspending them or going to have to cut them, then this is a moot point. So I would be very careful of that. And by the way, when the stock price goes down, when the company gets into trouble, what happens is what happened to General Electric. So in 2017, General Electric had a super high share price. It had a high price to earnings ratio. It was borrowing money very cheaply, buying back its own stock, giving high dividends, just like a lot of these companies are. And then they had to slash their dividend in half. The stock dropped by half. Then they slashed their dividend to a penny. And now the stock is trading about a third of its price that it was trading at back in 2017. So again, that's another myth that I would be very careful of. What about stocks? Listen, market timing is never a good idea, but it's really important for you to have a balanced plan that's based upon your age. So would I say sell all your stocks? Absolutely not. What I would say, though, is now is the time to know exactly what you own, because I have been doing second opinions for the last 2 years, and there is not one plan, not one, that is properly diversified and properly protected. Most people are not at all protected, and you have no clue about that. So you should know what you own. And if your plan is managed, I would suggest that you get an outside second opinion from an unbiased source. I don't sell financial products. That's why my opinion is unbiased, because I'm not going to try to manage your money for you. That's not my business model. My business model is not feeding you, but teaching you how to fish for your own fish. So the ABCs of money we all should have received in high school. If you know what you own and you know what a better plan looks like, and I outline areas of strength and weakness in your plan for you, you have an action plan and you're the boss. You can choose to do it or not. It's up to you. So another warning. So again, market timing doesn't work. But should you just hang on or write it out or buy and hope? No, those strategies don't work either. The last 2 recessions cost investors more than half. And this is a recession. By the way, if you're hearing, oh, are we headed into a recession? None of the economists or CEOs think that's a question mark. So when will you get the notice on that? At the end of April, I'm pretty sure it's April 29th, we're going to get our first quarter GDP results. It's going to be negative. It's just a question of how bad the contraction is going to be. Most people think it's going to be about -4%. Then we're going to get our second quarter GDP at the end of July. I believe that one's closer to July 30th. And that one is going to be negative, but a lot worse. Some people think it could be even -15% contraction. So it could be really like Great Depression-ish. Now, that doesn't mean we're headed into a Great Depression. I'm just saying that the contraction is going to be pretty severe. I mean, we've never had anything like this. And, you know, if we go back to the plague and stuff like that, of course we have. And, you know, stocks have been trading in England since, you know, over a century and a half. So there have been people that have experienced things like this. And especially, you know, the East-West mercantile companies back in the 1600s and all that. But in our recent memory in the last century, this is a pretty significant event. We can still have a rally after we get through it, but there is the consensus is still out about when we get through this. So I wouldn't bet on great times and I wouldn't bank on terrible times. I would just be properly diversified. I would be overweighted safe. So we're overweighting 20% safe. So in other words, you're pretending you're 20 years older than you are. I would be properly diversified. I would have some hots, so some things that can go up if the markets go down, or some things that are severely underpriced that maybe have been sold off too much, or some things that can remain buoyant, like perhaps consumer staples and utilities might even be a hot slice. What about bonds? They are highly leveraged and they lost money in 2018. So if I were you, I'd be very concerned about my bonds. In general, I think that getting safe in today's world is a 2-step process. It's so important that we spend 1 full day on it in the retreats. So again, the online retreat is not this weekend because it's Easter in the United States, I think around the world, and but it will be the following weekend. So it's going to be April 18th through the 20th. It's our most affordable retreat. And as you can feel from this video conference, it feels like I'm in your living room. So it feels actually even more intimate in many ways than our in-person retreats. Also with the screen share, which I will share the screen and show you a few things so that you can see. It's really great. So I encourage you to consider joining us. It's important for your health, your physical health. Your physical health is the most important. There's no wealth without health. But after you make sure that you're safe, make sure that your wealth is safe too. And make sure that you have a budgeting plan that's 21st century. We know by the amount of consumer debt in the world, which is higher than ever, and corporate debt in the world, which is higher than ever, that we've all been borrowing from Peter to pay Paul. And that is not a good strategy. There are ways of rethinking the way that we live and the way that we budget. You can save thousands of dollars annually with smarter big ticket choices. So some of it's going to be brave new choices about lifestyle, but a lot of it's just going to be smart choices, and stop making, you know, all of the companies rich at your own expense that you think are bills. If you were just thinking smarter about it, then your bills could be like this instead of like that. So what's safe? Safe income producing hard assets that you purchase for a good price. There's not one word in that sentence that doesn't count. Before you can purchase something for a good price that's going to produce income for you, you got to keep your money. That means that it should be FDIC insured. Or if you're Canadians on this call, it should be federally insured. You have to be aware of money markets, annuities, and life insurance right now. Life insurance companies and annuity providers get into trouble in recessions because their assets go down when the stock market goes down so severely, and the bond market. And also, if they promised you 3%, and they're only able to get like 1% or 0.5% on their treasury bills now, that's not a business model that works. And by the way, that's the cliff notes from the CNBC interview with Warren Buffett. So you might have even seen a bunch of headlines about how Warren Buffett said, don't sell. But if you really listen to the interview, he didn't say that at all. And he said a lot of other really valuable things that you could have used. What is Warren Buffett's intention behind all this? Usually he's pretty candid, but the interviewer or the network often takes a snippet of what he says and builds a whole article around that. So you really have to listen to the whole interview to get his wisdom. We now have 24 trillion in debt. It's actually more than that when you start adding up. I think they just haven't been able to add as fast as we've been making promises. One other thing I want to say is really important, and I put a link to Jerome Powell's speech from this morning. If you need a link to the minutes from the Federal Reserve meeting, okay. But I've been giving you the cliff notes on it in my blogs. And again, he told us all about this in the press conference back in March. So there wasn't really much news in the notes that he hadn't already discussed in the press conference. So the bottom line is that the bond market is in trouble and the feds are trying to bail it out, but there will be winners and losers. And that's what's important, is that they lend money, they don't spend money. And that's in Jerome Powell's words. So what that means is they only are going to bail out the companies that they think can actually pay them back. There will be companies that can stay in business. For example, Ford will stay in business, but they may not necessarily receive a loan from the Federal Reserve, and that until or unless they restructure their existing debt. Because the Federal Reserve, if they feel like they are, that their plan is unsustainable right now, they'll go ahead and let them restructure their debt, just as happened, by the way, in the Great Recession. So the Great Recession, we had all of this bailout money, and it did not flow to Chrysler or to General Motors. They let them go bankrupt, restructure their debt, they stay in business, and that may happen to Ford. It may happen to Boeing. We don't know who they're going to rescue and give the loans to, and who they are going to let them restructure. Again, a company can stay in business and restructure their debt. And that's why bond funds are very vulnerable right now. That's only one of the reasons why. But also municipalities, by the way. Municipalities were already not that great and very over-levered. And now we have stay at home, and they're suffering from their tax revenue base has just gone kaput too. So I would be going through my bond portfolio. And if I had bond funds, I would probably be very underweighted and be very interested in FDIC insured in cash. And then again, with an eye towards envisioning what is the type of safe income producing hard asset that works for me. Thinking of 21st century solutions, you can't just think the way you thought even a year ago. Oh, I'll buy a place and I'll Airbnb it. I don't know what the sharing economy is going to look like post coronavirus. You know, people are not that into sharing right now, right? So you have to have 21st century ideas, not even 2 weeks ago ideas. They have to be brand new. And again, we do discuss that. There were trends emerging even before this happened. We could already see the writing on the wall. So there are some really exciting areas to be thinking about. Again, are we headed into a recession? We're in one. There's no economist that I'm following that thinks we're not. But again, you don't get, the general public, Main Street, will not get the official headline. And that is because we can't give the official headline until there are 2 quarters of contraction. So that cannot happen until the end of July, when we get our advanced GDP report on the 2nd quarter. That's why we can actually be in a recession, but you don't get notice of it for months. So again, those really important dates to keep in mind are the end of April is going to be a pretty bad GDP report. At the end of July will be the official recession headline. And it will also be a tremendously terrible GDP report. The only real question is, will we all be back to work by then? Probably not all, but maybe we will be at least back getting, ready to start getting back to normal. There probably will be less travel, less tourism. Some of the businesses that were already very over leveraged will have trouble. I've already heard from people that, the businesses have already declared bankruptcy. I'm not going to say which ones that I know because the insiders have been laid off. But, there's a lot. There's a lot of things that were unicorns 30 days ago that no longer seem to be around. So when will the rally occur? The jury's out on that. Mnuchin is saying that we'll start getting businesses reopening in May. Jerome Powell is saying probably after July. We don't know, honestly. We just don't know. We're hopeful. The sooner we start reopening, the sooner we can start recharging the economy. And we all want to do that. Let's face it. None of us are, there are blessings of being, staying at home with your children and all of that. But the truth is, we all like working. We all like having gainful employment and lovely lives. So we all want to get it back. I think it's important for you to be aware of the amount of leverage that was already in the economy before this happened. It's interesting because, the minutes that I read and the information that I read, they're saying that, that Main Street needs to be helped and they're going to help out small business and people and all that. But the truth is, the first people that needed to be helped were businesses, corporations, and that's because of the massive amount of over leverage. Again, I have said this number a lot, but I think it bears repeating. Half of the corporate bonds are at the lowest rung, just above junk bond status. That is very over leveraged. And it's been something that the Feds have been talking about for months, saying, look, we need to stop spending more than we bring in. Our corporations are over leveraged. We think it's okay, but this is still something we have to monitor. So if you haven't looked at my asset bubble chart, then I'm pretty sure I included it in that blog that you can link to in the chat box area. And if you don't see it there, which you should, then just email Heather and she can send it over to you. And by the way, in order to increase our score and no longer get blocked by spam, we have had to, restructure how we send out our emails. So you now have an email that comes to you from an email account that you cannot correspond with. So you must still correspond with us through info@nataliepace.com. Don't just hit respond when you get a mass email from us. So we do have 6.6 million unemployment claims. That's pretty astronomical for, a month period or a two, it's pretty bad. If you sell now, you'll be selling low. That's a common myth. Again, the markets are at 23,000. The low in the Great Recession, which wasn't that long ago, was 6,547. 6,547. All right, I do have one question that was emailed in. Again, I'm going to try to do these conferences at least 2 times a month because things are moving that fast. But the most important thing for you is to make sure that you are safe, protected, hot, and diversified. Now is a fantastic time to do that. Would I wait for the markets to come back? No. If I did it 2 weeks ago when the markets were at minus 35%, would I be ruining the day or thinking, oh my God, I sold low? No. The reason is you can never sell high and buy low. You can get close, and that's what the pie chart system with annual rebalancing does as good as it can for you. You can be properly diversified, rebalance once a year. Your big slices now need to be trimmed back, that's selling high. Your skinny slices now need to be beefed up, that's buying low. So that's why you don't use market timing. But if you are, as an example, 50, and you're overweighting 20% safe, and 30% of your portfolio loses 20%, then your losses are actually about 10%. So it's, less than 10% of the entire portfolio. So that's how it protects you, by keeping the proper amount safe. And actually, if the safe side earns gains for you, which it won't this time around, if keeping your money is more important than reaching for yield, and if the hot side earns money, then you can actually earn gains. That's how people earned gains in the last 2 recessions, using the pie chart strategy. And the annual rebalancing is a buy low, sell high plan on autopilot. So if you came to the retreat 10 years ago and you haven't rebalanced, now is the time to do that. Now is the time to put, and also one last tip, you have to put your holdings into the pie chart. You can't just work off the holding statements, because that takes the emotions out of it, and it also allows you to compare apples to apples and use the pie chart system to your advantage. If you're looking at the holding statement, things that have gone down are in red, and that makes your stomach acid go, oh my God, I made a terrible mistake there. And things that are have gone up are in green. You're like, oh great, we're at a party here. That's that's the opposite of what you need to be doing. That's why the pie chart helps you, because if it's nice and big and much bigger than it should be, which would be in green on the holding statement, you are now prompted to sell high to get it to the slice that it should be. And if it's really tiny, then if it's a hot, what's hot does change every year, and what's safe changes every year. So you will be looking at the hots and saying, do I think it's still hot going forward? That's the first question. And if you do, then the right answer is buy more low. Now, caveat, if you have cannabis, make sure you've picked the right company. So because you have to do your own cannabis fund of your own cannabis companies, you have to treat it like a stock on steroid too. You have to do the stock report card, ask the 4 questions, look and see who's running the company, make sure they are good at running the company, make sure they have enough liquidity, all that sort of stuff. So the bottom line is, now is the perfect time to know what you own. Now is the perfect time to learn a time-proven system. Now is the perfect time to stop believing the 20th century strategies that have not worked at all in the 21st century. What are some of the 20th century strategies that haven't worked? Buy and hope, write it out. Dividends are great. They're great. They're not great if you lose your money. It's not cool to earn a 4% dividend and lose half of your money. That's not cool at all. And by the way, once a company gets into trouble, they cut the dividend anyway. And it looks like, oh, by the way, one last thing. Next week, we will be hearing from the banks. And this is when we'll start hearing whether or not the banks are going to suspend their dividends or cut their dividends. They will probably have to at least suspend them at some point. We'll see. Wells Fargo may have to be the first one to suspend it, but we'll see. That will give us something to talk about at the retreat and also in my next teleconference. So let me go to the question that was asked. Are we at risk of entering a state of hyperinflation with the huge amount of government spending that our governments are now doing? If yes, is it wisest to move a large amount of FDIC insured cash currently held in the bank into real estate now before it loses its purchasing power, despite real estate being on the high side? Again, it's lightning round, so I can't give you all of the particulars. But in general, the first thing that is going to happen that we're already experiencing is deflation. And if we start to experience hyperinflation, of course, you don't get much advance notice on that. But I don't think buying high or buying out of fear is ever a good idea. Real estate is expensive, not only the price, it's expensive to maintain. And if you remember the whole clause, safe, income producing, hard assets that you purchase for a good price. So if you can't purchase it for a good price right now, then it's not necessarily a good investment. And if it's not income producing, and those things may take you some soul searching and some kick the dirt to understand. And by the way, if you have real estate, if you have businesses that were income producing in the past and are no longer income producing, then you actually need to be looking and saying, in going forward, how am I going to have this produce income? And if it's highly leveraged, so if the capital value of your real estate would go down by 20% and be underwater on the mortgage, then you might really start figuring out what you want to do with that. So I would be, if I had real estate right now, I would definitely be looking at it as a business and evaluating it as a business and protecting my own assets from the business. Remember that your own retirement accounts are the best protection you have from the business. So make sure you're doing that. All right. So if you, again, if you have questions or anything like that, it's best done in a coaching session. These teleconferences are to inform you and to empower you, and maybe one or two questions in a lightning round. All right. And if you need a second opinion, then get on it now, because obviously I'm going to be very busy next weekend with the retreat. If you'd like it done before the retreat, then you better reach out to Heather now. All right. Thank you for joining me, and I look forward to our next teleconference. And those of you that are coming and joining me at the retreat will have a great time. Stay safe, stay healthy, stay home, stay strong. Take it seriously now, that now is the time you want to protect your wealth, preserve your wealth, rethink anything that might be over leveraged. Start thinking about how your protected wealth might produce income for you in a way that works in the 21st century post-coronavirus world. And we'll discover, and we'll be plumbing that soil in our retreat and maybe even in upcoming blogs, but it's one day at the retreat. Thanks so much, and I look forward to seeing you guys again soon. Goodbye now.